I'm Teresa Bailey, host of In the Money. On December 22nd, 2017, the Tax Cuts and Jobs Act was signed into law. Now it's tax season and time for you to figure out what these changes could mean for your future tax returns. Joining us today is Kelly Crow, Senior Tax Manager with Reynolds, Bone and Griesbeck PLC. Kelly is also the current president for the Memphis chapter of the Tennessee Society of CPAs. Kelly's going to share with us several scenarios that could apply to your household. She'll also discuss why it's so important to consult a tax professional. Stay tuned as we sit down to chat with Kelly Crow.
You are watching Germantown Municipal Television, your source for everything Germantown.
Today we're discussing possible tax implications of the tax reform for your household. Joining us today is Kelly Crow with RBG CPA firm. Kelly, thanks for being here today.
Thanks for having me. I'm excited to be here.
Great. It's tax season, so a big thank you.
It's tax season, so thank you for the break away from the desk.
I imagine it gets pretty hectic.
It does, but it's a good time of year.
And tax season officially starts when?
Well, the IRS opened for e-filing on Monday, January 29th, so they're accepting returns in February, I want to say April 17th is the last filing day.
Oh, wow. So thank you again for taking time out. We appreciate it. So before we get started, tell us a little bit about yourself and what you do every day.
All right, well, during the day, I'm a senior tax manager with Reynolds, Bone and Griesbeck, so I specialize in high wealth individual taxation as well as investment and real estate partnerships. And then I really love not-for-profits and employee benefit plan as well.
Awesome. So from day to day, not during tax season, what do you do with yourself?
We do a lot of tax planning throughout the year. We try to work with our clients to see changes that may be going on in their life, anything that could impact their tax return in the next year. We also want to make sure that we're working with fiscal year-end clients to get their taxes filed. So there's a lot that keeps us busy. And anytime there's a new tax law, we stay very busy.
I was about to say, and then you get thrown a curveball where we have tax reform. And then, so I'm sure at the end of last year, it was pretty hectic for you.
It was hectic, but exciting. We haven't had this comprehensive of tax reform since 1986. So it's actually been a really exciting time for probably tax practitioners across the U.S. to, learn all the new facets of the law. It's also been a little difficult because while Congress made the law, the IRS now has to catch up. So there's still some uncertainty, but we have certainty on a few different areas.
Awesome. So what do we need to know, big picture, about this act and what it means for us?
So today I think we'll focus on individual taxation. There were a lot of business tax changes and there were also estate and gift changes, but for individual taxpayers, there are some provisions that are going to change their tax returns for 2018. As you mentioned earlier, the tax law was signed December 22nd of 2017, but most of the laws don't actually come into play until January 1st of 2018. And the IRS actually just released withholding tables that have to be implemented by all employers by February 15th of 2018. So that'll be a change that most taxpayers will see in their paycheck within the next month.
So what should they be doing? Is it something that they're going to have to manually go through HR or their employer? Or
that's the beauty of it. Employers have to are mandated to implement the new withholding tables. So the W-4s that an employee has filed will stand, and the IRS has issued new calculations that employers will follow.
Now, this brings up a good point about in this age of do-it-yourself, everybody wants to redo their house themselves, maybe do their taxes themselves. With something like this coming up, how do you know when you can really DIY and do it yourself, or you need to work with a tax professional?
I would say if you're starting to get into a more complex tax situation where maybe you have some complex investments, you have some K1s, those types of investments that aren't your standard, usual, average taxpayer income items, I would definitely suggest that you consult with a tax professional and at least have someone review your tax return that could help you and guide you through some of the new provisions that we have.
Uncertain provisions, as you
Very
said
uncertain.
earlier.
Some of them are very uncertain, yes.
Now, you did provide a couple cases for us to
Yes.
review that we might find familiar in our world. So tell us about the first scenario that we have.
Well, we're going to visit with the Flintstone family today. So
fun.
our first scenario is going to be Pebbles Flintstone. And Pebbles is a single taxpayer. She has no children. And for 2017, her wage income was right at $60,000. And she had a little bit of bank interest, $15. And then she is a typical millennial. She's got some student loan interest. She's graduated. She's early in her career. And the cap on that deduction is $2,500. So for 2017, she is still going to get the $2,500 deduction. For 2017, she's also going to retain the standard deduction that was still in play of $6,350, and she's also going to still claim her personal exemption, which was $4,000. That brings her taxable income to $47,000 and total tax of $7,500. But when
So,
you
go ahead. So for 2017, pretty much what she had in 2016 translates over.
exactly,
Okay.
yes.
So we'll move on to 2018 and talk about maybe some things that might be different for her.
Sure. So in 2017, you'll see that her tax rate would have been right at the 25%. She fell into the 25% bracket. However, for 2018, if you keep all of your income and deduction items the same, assuming everything is the same, she'll be in this lower 22% bracket, which is a new bracket that was established under the law in December. She'll still get the student loan interest deduction. There was a lot of confusion and a lot of uncertainty in December as the House and the Senate were going back and forth and negotiating about whether some of the education credits and some of the education deductions were going to be retained. And at the end of the day, the American Opportunity Credit and the Lifetime Learning Credit were all retained, and the student loan interest deduction was retained as well. So she'll still get the student loan interest deduction.
So no changes made to that at all.
No
you can
changes
expect
made.
what you previously had to continue forward.
Exactly.
Okay.
What she is going to get, though, and one of the key changes in the new law is the increased standard deduction. And what you'll see is that the standard deduction for 2017 was right at $6,300, but for 2018, it was nearly doubled for a single taxpayer to $12,000. This was across the board, so married filing joint taxpayers will also see an increase in their standard deduction.
That seems like quite a gift.
It is.
Right?
That's what you think. And then you go to the next line and you'll see that there was a loss, there was a suspension in the personal exemptions. So everyone will lose the personal exemption that they've had for several years. But at the end of the day, if you look at the chart, her taxable income decreases $1,600, but because of the reduced tax rate, she has tax savings of almost the exact same amount, dollar for dollar, $1,565. So it's pretty impressive with a tax rate change, the difference that you get there.
So for her, is there any planning that she needs to do?
Yes, I would suggest for a single taxpayer such as Pebbles, definitely look into your retirement plan options. There are 401ks that companies provide that are great ways to reduce your taxable income and also save for retirement. That would be something we would definitely recommend for her.
Okay.
And
all right.
also, she could look into a traditional or a Roth IRA. Those would be good options too.
So we have to take a short break, and when we come back, we will talk about our next case study. We'll be back in a moment with Kelly. Stay with us.
Oh, emojis! I thought the conversation just got dumber.
Ugh, internet trolls, just ignore them.
I like you just the way you are.
I believe in you! She's a hugger. Give her a squeeze.
Help up the hand.
Ah, there you go.
Thanks, mate.
You're killing it, Jane!
Hey, let's check out this park. looks really cool. To find a great local park or forest near you, go to discovertheforest.org.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. If you're just joining us, we're talking about how the recent changes to the tax code could impact your future tax returns. Today we're joined by Kelly Crow with RBG CPA firm. Thanks again for being here during tax season.
Absolutely.
A big win for us. So I know this is a very timely topic. When we left, we were talking about the single taxpayer.
Right.
Really the planning opportunities are retirement plans, sort of the things that they've always been, but
Right.
they will experience a reduction in their overall taxes.
Right, and for a single taxpayer that's not itemizing their deductions, there's just limitations on as much planning that you can do. So definitely exploring retirement options is a really great way.
Good to know. So let's move into our second scenario
Sure.
that you've prepared for us. Tell us a little bit about this situation.
So with our second scenario, we're looking at Fred and Wilma Flintstone and their tax situation. And we'll start with 2017, the law, and I will just mention here too that the 2017 tax return that will be filed in April of this year in 2018, we're still going to see all the same tax rates that we've had for several years. So taxpayers may not see these changes on their tax return for 2017. They'll see a lot of these changes next April when we're filing the 18 tax return.
Got it.
All right, so Fred and Wilma, they've done really well. They have wages of roughly $115,000, a little bit of bank interest, and some qualified stock dividends. They've done some investing over time. They're a pretty standard American taxpayer. They've got sales tax. We're in the state of Tennessee, so we don't have an income tax other than the hall tax. And they have real estate taxes on their home, their primary residence. They also have a little bit of mortgage interest and some charitable contributions. They're charitably minded. Their total itemized deductions for 2017 come to roughly $19,500.
Okay.
And they will take exemptions for themselves. They also have 2 children, so they'll get $16,000 in their personal exemption. That puts them with a taxable income of $81,600. That's going to throw them into the 25% tax bracket, and so they'll have a regular tax of roughly $11,600, and then they do benefit from the child tax credit for 2017 of $1,600. And the child tax credit for 2017 was roughly $1,000 per child, and then there was a phase out, and that phase out started at roughly $110,000
Okay.
per family. So for if you're a married filing joint.
So because they made $115,000, they lost a little bit of that $2,000.
Exactly, they lost
Got
a
it.
little bit of the benefit there.
Okay.
Their total tax ended up for 2017 coming in right at about $10,000. And so if you look at 2018, you'll see there's going to be a little bit of a change. Their wages, interest, and dividends are going to stay the same. We're going to assume all those stay the same. But what you'll see is that they actually are going to take advantage of the expanded standard deduction that was included in the law. And we saw that with Pebbles as well. She got the benefit of the expanded standard deduction.
Okay.
They do lose the exemption. However, their taxable income increases roughly $11,700. That looks like it's going to be very detrimental to them from a tax standpoint. They're going to be paying a lot more in tax, especially with the loss of the exemptions and the itemized deductions. But when you look through the numbers and you look at the new tax brackets, they're going to fall into the new 22% tax rate, which is really beneficial for them. Their regular tax increases $600, but they get the benefit of the expanded child tax credit, which is a reduction of $4,000, which is just a really great benefit, and a lot of families are going to be able to use that this year.
So overall, the amount of their taxable income increased, but because their tax rate decreased, then they're going to have tax savings in the end.
That's right. In the end, they have a total tax savings of almost $1,800, and a big part of that is that child tax credit that they got because of their 2 children.
So let's talk about that. What if they did not have 2 children? What if they had 1 child or no children?
If they only had 1 child, the $4,000 in child tax credit would have been reduced to $2,000. And so what you would see then is a little bit of an increase, probably $200 to $300 in their tax, which is not great. If they had no dependents and no children, they would lose the $4,000 tax credit altogether, and their tax would actually increase $600. So Every situation is different, and we just advise clients or anyone who asks us a tax question, make sure you're talking with your tax practitioner. It's so critical because every tax situation is different, and everyone's family situation, income, and deduction situation can be vastly different from others.
So it might be for what this particular situation shows us is if you have a couple that's pretty high earners, no children, if they've been doing their taxes on their own, they may want to talk to somebody about other ways to get their overall taxable income down now because they're not going to have, okay.
They might want to look at that for sure.
Great. And then what other planning scenarios would you suggest for Fred and Wilma?
For Fred and Wilma, we would definitely suggest retirement planning similar with Pebbles. It's an easy way to look at if you can take a traditional IRA deduction, maybe contribute to a Roth IRA, or if your company offers a 401k, if there's a match, anything like that. That's a great planning opportunity for the future and also for tax savings now in most circumstances. We would also suggest that because they have 2 children, they might want to look into a 529 plan, which is an education and savings plan where they can put money into the plan and it grows tax-free, and they can take the money out later for their children's college education. And what's really cool is in 2018, that the 529 plan was expanded to include tuition for K through 12, and you can take $10,000 out per student per year to use for that education. So that's really great for taxpayers that are looking for ways to pay for private school.
Oh, that's a big deal. So in Tennessee, contributions to those 529 plans, do we receive any kind of credit for those?
There's not in Tennessee, because we just have the Hall tax. There's really not that much of a state benefit that you would see in other states like Maryland or states that have a higher income rate.
Got it. So any other planning situation?
Yes, we would suggest for Fred and Wilma that because they moved from a situation where they were itemizing deductions and now they're going to the standard deduction, they would definitely want to consider grouping some of their itemized deductions. So instead of paying their Shelby County property taxes in February of the following year, they may want to go ahead and pay it in December and get 2 years worth of deductions in 1 year. So going ahead and paying your 18 taxes by February of this year and then paying your 19 taxes in December, you would get the benefit of the deduction.
Got it. So you're sort of bunching your expenses together to get the greater amount.
And if you have charitable contributions, that's another way that you can stack some of those deductions and try to get into a position where you're able to itemize and really take advantage of those deductions.
Great. Well, we have to take a short break.
Okay.
We'll be right back with Kelly Crow.
We'd do anything for kids. Yet 1 in 6 children in the U.S. struggle with hunger. Help end childhood hunger near you. Learn how at feedingamerica.org.
So there you are, shuffling through a stack of resumes and you come to mine. This is it, first impression, my way in. But can my resume show you how I truly stand out? Like that I was studying, going to night school while working 2 jobs just to help my parents pay for groceries. Or being the first one to always step up. No, that's something you just can't put on paper. Look beyond the resume and discover new ways to develop great talent that is dedicated, hardworking, and determined like me.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. We're talking through tax changes with CPA Kelly Crow. Thanks again, Kelly, for being here.
Thank you.
I've very much enjoyed talking through the first 2 scenarios with you.
Good.
It's so much easier to have an actual situation that you can apply some numbers to.
I agree.
So we have our third situation. Why don't you go ahead and introduce us to Barney and Betty Rubble.
They probably sound familiar. They were best friends with Fred and Wilma, so they also live in the area. And Barney and Betty have a little bit more of a complex tax situation.
Okay.
They're really high income earners. They earn $325,000 in wages bank interest of roughly $1,000, and qualified stock dividends of $10,000. So their AGI is roughly $336,000. They've done really well over time. They also have a lot of Schedule A deductions: sales tax of $3,000, real estate taxes on their primary residence of $15,000, and a primary mortgage interest $20,000. And they do have a home equity line of credit that is $5,000 in interest every year. They have miscellaneous deductions of $5,000, and those are going to be your tax prep fees, investment advisory fees, miscellaneous job deductions, anything like that would fall into your miscellaneous itemized deductions. And then they also are charitably minded and gift $10,000 annually. Below that, you'll see that their total itemized deductions come to $58,000. However, for 2017, there was a Schedule A limitation. It's called a PEAS limitation, and what it is it's basically a haircut, if you will, on your Schedule A deductions for high income earners. So once you get to a certain threshold, the IRS says, all right, we're going to limit what you can actually deduct on your Schedule A.
Okay, so it's a little bit of a clawback.
It's a little bit of a clawback, that's right. A penalty for being a high income earner. So they end up with total itemized deductions of $57,000. For 2017, their exemptions are also going to be limited. The IRS limits both your Schedule A deductions and your exemptions if you're a high income earner. So those were limited to $13,000, bringing total taxable income to $265,000. This would put them in the 33% tax bracket. Regular tax would be almost $61,000, and they unfortunately fall into alternative minimum tax, which the bill in 1986 introduced a new tax called alternative minimum tax. And the really unfortunate side of that tax was that it was really intended for very high wealth income earners, very wealthy people in America, and over time, the AMT was never adjusted, and so it's really applied to more Americans than it ever has before. So with the new bill, we're going to see a little bit of a change to the AMT, and we'll see that with 2018. For 2017, they won't be able to take advantage of the child tax credit, and there was also an additional Medicare tax and a net investment income tax that they will be subject to.
Now, they couldn't do the child tax credit because they made too much.
Their income was too high.
Got
so
it.
like we saw with Fred and Wilma, where they lost a little bit of that credit, for Barney and Betty, they actually lose the full benefit of the credit for 2017.
Got it.
So total tax comes to $66,000. And now we will look at the 2018, which will be a little bit different. For 2018, income stays the same, but we're going to really look at Schedule A, because Schedule A had a lot of changes. There was basically a complete overhaul of our Schedule A changes. For real estate taxes, sales tax, personal property tax, the IRS, well, Congress really, has limited that deduction to $10,000. And that is going to be a really big deal, especially for taxpayers that have high real estate taxes, and especially for taxpayers if they're in a state that has income tax. In Tennessee, we're a little bit lucky that we don't have the really high income tax rate, but for a lot of average Americans, that's going to be a really big loss.
Well, what about sales tax? Like I'm one of those that I keep all my receipts, and instead of taking the standard deduction for that, I've actually kept up with the sales tax that I've paid.
Okay.
Will that apply now going forward?
Yes, you'll still be able to take the sales tax, but that in addition to your real estate taxes and your personal property taxes, you'll have to add all those up and it'll be capped at $10,000.
Okay, so everything goes together.
Everything gets mushed together.
Got it.
The mortgage interest on their primary residence will still be deductible at $20,000. Now the mortgage interest was changed. The cap on that now, you used to be allowed to deduct interest in proportion to your principal balance. That was up to $1 million. Now it's being dropped down to $750,000. But if you had the debt prior to December of 2017, the principal balance will be grandfathered in. So you'll be able to still take up to the $1 million.
Okay, that's good to know.
But there's a little give and a little take, of course. So with mortgage interest, if you have a home equity line of credit and that was used for personal purposes or it wasn't used to significantly improve your primary residence, you're no longer going to be able to take the interest deduction. So that's a little bit of a loss for some people.
So now, when you say personal use, do you mean, how is the IRS really going to, how do they define it? How are they going to check up on it?
Right. You have to be honest, Teresa. No, but the home equity line of credit, it can go towards your mortgage as long as it was used to improve the property that you're living in.
Got it, but no additional forms for you to file.
No.
You don't have to go to your clients' homes and make sure that they've done everything.
No, I will not be inspecting anyone's home. Absolutely not.
Good deal.
So the other loss for the Schedule A was the miscellaneous deductions. Those were suspended altogether. And I keep saying the word suspended instead of repealed because most of the individual provisions were actually only suspended until 2026. And so we're actually going to see a lot of these come back unless there's another law change.
Is this the sunset that everybody hears about?
This is the
that
sunset.
Doesn't sound like a fun sunset.
December 31st, 2025 is the sunset date for a lot of the individual provisions. So they will lose the miscellaneous deductions and they'll retain the charitable contributions. So that adjusts their Schedule A from $58,000 down to $40,000. So it's a pretty significant loss when you look at it with the $18,000. However, the new bill also repealed the P's limitation, which is a really great win for high income taxpayers as well. So that $40,000 will not be limited. There won't be a haircut, so they'll get the full $40,000.
Great.
Of course, they lose their exemptions just like Pebbles and Fred and Wilma to bring their taxable income to $296,000. The regular tax rate will be they'll actually jump down to the 24% bracket, which is pretty impressive.
So from 33 to 24, yeah.
Exactly. So the brackets we still have the 7 brackets that we had before. However, they were changed and modified. They were widened and the percentages were changed. So we still have 7. We thought we might go down to 4 brackets, something that was a little more simple, but we retained 7. The child tax credit, they'll get the full $4,000, which is really impressive. The child tax credit, again, was expanded up to AGF $400,000 for married filing joint. So a lot of people are going to be able to take advantage of the child tax credit. And then the Medicare tax and the net investment income tax will stay the same. So taxable income increases $30,000, but with all of the reduction in the regular tax, the overhaul of the AMT that they'll no longer be subject to, the addition of the child tax credit, they have total tax savings of $10,700, which is really impressive.
That is. So we only have just a little bit of time left.
Sure.
What are the 2 big planning opportunities for Barney and Betty and why they should come see you?
It's very similar to Fred and Wilma. We would suggest that they might look at some of their charitable contributions, maybe delay some of their charitable contributions, try to stack those deductions a little bit more, and then do retirement planning. It's so important, and then the 529 plan expansion is just a really great benefit as well.
It sounds like it. Well, thank you so much for being
Thank
here.
you for having me.
Again, I know I keep saying it, but it's tax season, so I know this was a big deal for you to be here today. Thank you so much.
It was great, and it's a fun time to be a tax practitioner. So.
I bet it is. Today, we reviewed how the recent tax changes to the tax code could impact both your future tax returns as well as decisions throughout the year, such as how you pay school tuition and even when you pay your property taxes. Also, how important it is to review these changes with a tax professional like Kelly. That's all the time we have today. Thanks to Kelly Crow with Reynolds, Bone, and Griesbeck PLC, and thank you for watching. If you'd like to see more shows, follow us on YouTube or Facebook at Germantown Municipal Television. You can also visit our website at gmtvonline.org. Each person's financial situation is unique. Before making any decisions, please speak to a financial professional to see if our discussions today are in your best interest. We'll see you next month. I'm Teresa Bailey, and now you are in the money.